Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Fed Policy and Your Wallet, Navigating Financial Changes. Interpreting Federal Reserve Announcements. Understanding how Federal Reserve announcements can impact your money is essential for financial literacy. Let's dive into how these announcements can affect financial markets and provide insights into optimizing your financial planning strategies. Market reactions. When the Federal Reserve makes announcements regarding interest rates or monetary policy, financial markets often react swiftly. Positive news from the Fed, such as lowering interest rates, can lead to increased borrowing, stimulate economic growth, and boost stock prices. On the other hand, hints of interest rate hikes may cause bond yields to rise, affecting mortgage rates and investment returns. For investors, these fluctuations mean staying informed and prepared. It's crucial to monitor market reactions to Federal Reserve statements closely to adjust investment strategies accordingly. Diversifying portfolios, considering long-term goals, and seeking professional advice can help mitigate risks and capitalize on market opportunities amid Fed announcements. Financial planning strategies. In response to Federal Reserve policy changes, individuals can take proactive steps to optimize their financial planning. When interest rates are low, consider refinancing loans, including mortgages, to take advantage of reduced borrowing costs. For savers, exploring high-yield savings accounts or investment options offering better returns can help combat the impacts of low-interest environments. As the Fed adjusts monetary policy, reviewing and rebalancing financial plans is crucial. Focus on consolidating debts, building emergency funds, and investing in assets that align with your risk tolerance and financial goals. By staying adaptable and informed about Federal Reserve decisions, you can navigate changing economic landscapes and position yourself for long-term financial security. Future outlook and considerations. In today's ever-changing economic landscape, it's crucial to keep an eye on the future and consider how Federal Reserve policies may impact our finances. Let's delve into what the future may hold and how you can prepare for potential changes. Economic forecasting. Staying informed about economic indicators and Federal Reserve pronouncements is key to making well-informed financial decisions. Economic indicators like GDP growth, inflation rates, and employment data provide insights into the health of the economy. Keeping track of these indicators can help you anticipate potential shifts in Federal Reserve policies, such as interest rate changes. By understanding how these factors interplay, you can better position yourself to adjust your financial strategy accordingly. Monitoring economic forecasts and experts' analyses can provide valuable guidance in navigating the financial landscape with confidence. Risk mitigation strategies. Uncertainties can arise from changes in Federal Reserve policies, impacting your financial well-being. To protect your finances against potential risks, consider implementing risk mitigation strategies. Diversifying your investments across different asset classes can help spread risk and minimize potential losses in case of market fluctuations. Maintaining a well-rounded emergency fund can also serve as a buffer against unexpected financial challenges. Revisit your budget regularly and ensure you have adequate savings to cover essential expenses. Being proactive in managing your financial responsibilities can help mitigate risks associated with changes in Federal Reserve policies. Consider consulting with a financial advisor to tailor risk management strategies to your specific financial goals and circumstances. By being prepared and proactive, you can navigate potential uncertainties with greater peace of mind and financial security. Federal Reserve policy has a direct impact on your money. Interest rates, inflation targets, and economic stability all stem from decisions made by the Federal Reserve. These policies shape the cost of loans, the value of savings, and the overall economic environment. Staying informed about Federal Reserve decisions can help you make smarter financial choices, from home buying to saving for retirement. Always keep an eye on their announcements and consider how changes could affect your financial goals. Interpreting Federal Reserve announcements is crucial for investors, economists, and policymakers, as these communications provide insights into the central bank's monetary policy stance and economic outlook. The Federal Reserve's decisions on interest rates, quantitative easing, and other policy measures significantly influence financial markets, economic growth, and inflation expectations. When the Federal Reserve signals changes in interest rates, it directly impacts borrowing costs for consumers and businesses. A rate hike generally indicates efforts to curb inflation, potentially slowing economic activity and affecting stock and bond markets. Conversely, Rate cuts aim to stimulate economic growth by making borrowing cheaper, which can boost equities but may raise concerns about inflation. The Fed's commentary on economic conditions, including labor market health, inflation trends, and global economic factors, helps market participants gauge the future direction of monetary policy. Phrases like accommodative stance or tightening policy are closely analyzed to predict policy shifts and their implications for various asset classes. Furthermore, forward guidance and projections from the Federal Reserve provide critical information for shaping investment strategies and economic forecasts. Investors adjust their portfolios based on anticipated changes in interest rates and economic conditions, while businesses make strategic decisions on spending and investment. In conclusion, interpreting Federal Reserve announcements is essential for making informed decisions in financial markets and economic planning. Understanding the implications of the Fed's policies on interest rates, economic growth, and inflation enables investors and businesses to navigate the economic landscape effectively and align their strategies with the anticipated policy trajectory. At the heart of the Fed's toolkit is the manipulation of interest rates. When the economy overheats and inflation threatens to spiral out of control, the Fed may opt to raise interest rates. This move makes borrowing more expensive, which can curb spending and investment, thereby cooling down the economy and reducing inflationary pressures. Conversely, when the economy slows down and unemployment rises, the Fed may lower interest rates to stimulate economic activity. Lower interest rates encourage borrowing and spending, boosting demand and reducing unemployment. These rate adjustments have widespread implications for consumers, investors, and businesses alike. For savers, changes in interest rates directly impact the returns on savings accounts, certificates of deposit, CDs, and other interest-bearing accounts. When the Fed raises interest rates, banks typically follow suit by offering higher interest rates on savings products. This benefits savers by providing them with increased returns on their deposits. Conversely, when the Fed lowers interest rates, savers may see a decline in the interest rates offered by banks, resulting in lower returns on their savings. Investors also feel the effects of Fed policy through changes in asset prices. When interest rates rise, bond yields tend to increase, making fixed-income investments more attractive relative to stocks. As a result, investors may shift their portfolios towards bonds, causing stock prices to decline. Conversely, when interest rates fall, bond yields may decrease, prompting investors to move towards stocks and other riskier assets, potentially driving up stock prices. Moreover, changes in interest rates can influence the value of the US dollar and impact international trade. When the Fed raises interest rates, the demand for US dollar-denominated assets increases, leading to a stronger dollar relative to other currencies. This can make imports cheaper for U.S. consumers but may also make U.S. exports less competitive in international markets. Conversely, when the Fed lowers interest rates, the value of the dollar may weaken, making exports more competitive but potentially increasing the cost of imported goods. Borrowers are directly affected by changes in interest rates, as they determine the cost of borrowing money. When interest rates rise, banks typically raise the interest rates on loans and credit cards, making borrowing more expensive for consumers. As a result, borrowers may face higher monthly payments and increased overall borrowing costs. Conversely, when interest rates fall, borrowing costs tend to decrease, making it more affordable for consumers to borrow money for various purposes. To navigate the impact of Fed policy on their wallets, individuals should stay informed about current economic conditions and the Fed's monetary policy decisions. Monitoring economic indicators such as inflation, unemployment, and interest rate expectations can provide valuable insights into the direction of Fed policy and its potential implications for financial markets and the economy. It is also essential to review and adjust investment portfolios and borrowing strategies in response to changing market conditions. Diversifying investments across different asset classes can help reduce risk and mitigate the impact of interest rate changes on investment returns. Similarly, exploring options to refinance loans or consolidate debt when interest rates are low can help borrowers take advantage of potential savings on borrowing costs. Moreover, maintaining a balanced approach to personal finances, including budgeting, saving, and managing debt, can help individuals navigate financial changes more effectively. By staying disciplined and proactive in their financial decisions, individuals can position themselves to weather economic uncertainties and achieve their long-term financial goals. In conclusion, understanding how Fed policy affects your wallet is essential for making informed financial decisions and adapting to changes in the economic environment. By staying informed, diversifying investments, and managing borrowing wisely, individuals can mitigate the impact of Fed policy on their finances and pursue financial security and stability. The Federal Reserve, often referred to as the Fed, wields significant influence over the economy through its monetary policy decisions. Understanding how these policies affect your wallet is crucial for navigating financial changes effectively. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.